Should we all quit growth stock investing? After all, Cathie Wood, who is the god of growth investing, has her flagship ARK Innovation ETF down 63% from all-time highs, and is down over 50% so far this year. A portfolio that's focused predominantly on disruptive innovation, investing in companies like Tesla, Roku, Zoom, Coinbase and Block have all taken an absolute beating. Roku down 78%, Zoom down 75%, Coinbase down 68% and Block down 66%. Tesla is holding up just a little bit in comparison to the others anyway, but nonetheless is still been selling off quite rapidly. Now what's crazy to think about is if you'd invested into any of these kind of companies like Cathie Wood did anywhere near the top of their market prices, then as at today, for every single dollar in which you'd invested, then it'd actually be worth roughly about 20 to 40 cents instead. And that is a crazy amount of value and a crazy amount of unrealized losses for any investors to suck up. Thankfully for Cathie, she's still got about $12 billion in net assets in this portfolio, so she'll be absolutely fine. But for people like me, and thankfully I'm not too exposed to growth stocks, but for just the 3 growth stocks that I'm personally invested into, I'm actually down just shy of $2,000 on just those 3 positions. And for any of you guys who did go on to invest into some of these more speculative growth stocks, you could say, anywhere between the kind of 2020 to 2021 growth stock mania, then you're probably seeing the same kind of pain within your investment portfolios at the moment. But with both the Federal Reserve and the Bank of England both hiking interest rates in order to curb the levels of inflation, which has certainly caused the stock market to crater once again this week, and as of right now it certainly looks like there's no signs of this stock market correction slowing down anytime soon. In actual fact, it potentially looks and feels like there's going to be a little bit more downside to come, so profits on these kind of growth stocks, which me as well as many of you guys have probably invested into, probably won't be seen anytime soon. In actual fact, based on current market conditions as of today in the broader macroeconomic environment, then actually investing into growth stocks is an extremely unfavourable play. And instead, some of the more safer stocks are actually the stocks that are holding their value in these more turbulent times. So is it now time to call it quits on growth stock investing across the board and instead perhaps load up on some blue chip stocks or even some ETFs instead? Well, let's dive into it. A couple of days ago, the Berkshire Hathaway annual shareholder meeting took place, where Warren Buffett actually didn't speak too favourably on the stock market itself and how investors are currently treating the stock market and their investments. Let's take a listen.
In the last couple of years, the stock market is it's always been a combination of a casino and when I talk about Wall Street, I'm talking about the whole capital formation market, and trading market, etc. But the market has been extraordinary. Sometimes it's quite investment oriented, and other times it's almost totally a casino, and it's a gambling parlor.
Wall Street have been enticing investors with the IPO bell of the latest hot stock, only to chew those investors up and spit them back out. Kind of like we saw with the Robinhood IPO, which IPO'd at $35 per share, only to be valued at less than a third of its IPO value today at just $10 per share. Or stocks like Rivian Automotive, who IPO'd at $78 per share in just November last year, only to be worth now $30 per share today. A stock that only made $55 million in revenue in 2021, but was valued close to $100 billion at its absolute peak. And I'm certainly not saying that all of these kind of IPOs were a complete speculative gamble. However, based on some of the valuations which we saw, then you can certainly kind of see where this narrative comes from. And with us now facing into a market where inflation is hot and interest rates are rising, we've actually moved away from what was pretty perfect market conditions for growth stocks to certainly prosper in, to now the complete opposite, where actually market conditions are certainly very unfavourable. And I think, if anything, this just goes to show how quickly things can change when you're investing. Because a couple of years ago, the CEOs and the CFOs and the top dogs within some of these companies actually saw it as an opportunity to probably just raise some capital for their businesses. In reality, the stock market was booming and in kind of bubble territory, and as a result, these smart business people thought it was a a perfect opportunity to actually IPO their business. It's no wonder why we saw a record number of 951 IPOs last year, compared to an average over the course of the past 23 years of about 238 per year. It certainly goes to show the abundance of money that was available in the past couple of years, with the Federal Reserve printing a ton of cash, interest rates being low, but unfortunately for the investors of today, all of that has come to an abrupt end. And as a result, many of these high-profile IPOs back in 2020 and 2021 certainly haven't lived up to their full potential, or at least as of right now anyway. Which is where I guess you kind of get back into that debate around whether these stocks are complete gambles. Is it simply as risky as picking a number on a roulette wheel and hoping that it comes in? Well, in my personal opinion, I think in the short term, some of these more speculative growth stocks certainly won't be returning to kind of previous all-time highs anytime soon. And in actual fact, some of these companies may never provide a return on investment. Let's take a completely random stock like Lucid Motors as an example, which was a very high-profile IPO which took place. In order for that stock to actually get back to its previous all-time highs based on today's current market price, it would need to go up in value 194%. That's a significant turnaround from current levels, and certainly relies heavily on the future success of the business and the business becoming profitable over time and being able to continue to grow, along with the macroeconomic environment also being favourable towards growth stocks too, which is largely going to require a bit of an undoing of what we're seeing right now, where inflation comes down to somewhat of a normal level and perhaps interest rates don't become too out of control. And whilst one of those variables is certainly within their control, the other variable isn't. I guess it's kind of like getting into a boxing ring with one hand tied behind your back. For a lot of these stocks, they're certainly going to be tested, backed up against the rope so to speak, at least for the next couple of years. But unfortunately, many of these stocks will get knocked out cold and never ever get back up, similar to how Tyson Fury knocked out Dillian White just a couple of weeks ago. But for the stocks that can get up when they get knocked down, well, they stand a chance of winning the fight when the odds come back in their favour after they're faced into the eyes of adversity. And this is where fundamentally the cream of the crop will rise to the top. Meaning if you've played your cards right and invested into some of these companies that will inevitably be successful over the course of the long term, then you should certainly benefit. However, don't let me dumb this down, because it is like picking a needle in a haystack, which is where it becomes extremely difficult to actually pick the right stocks. And don't get me wrong, it's not impossible, but it is much harder, and because of that, it certainly does come with a higher degree of risk when you're stock picking within the market. So I guess as of right now, all of the growth stock investors are certainly sat with a bit of a dilemma. Do you go all in like Cathie Wood and solely continue with the investment strategy which you have, which relies on the recovery and the growth of these growth stocks in the future, whilst bearing in mind that it might be a bit of a struggle for the next couple of years, but you've probably got in the back of your mind that market prices are now low and therefore have the potential to go up exponentially over the course of perhaps the next 5 years? Or do you play it safe, pick out some reliable blue chip companies, perhaps even a good old classic S&P 500 ETF, and just slowly wait for the market to recover? Well, I guess that comes down to you guys and your personal preferences and your overall tolerance for risk. Regardless, I think it's probably sensible for me to say that growth stock investing is a pretty tough arena to be in at the moment. Many of the stocks will fall to the wayside and only a few of them will actually turn out to be a good investment. So be sure to do your due diligence and your research and your analysis when you're investing into stocks, because if I think the current market conditions are anything to go by, and if there's anything to learn from the current conditions which we're facing into, is that the stock market, regardless of how euphoric it can feel in the moment, just a couple of years ago, that things always inevitably come back down and revert back to some kind of fair value. So I think regardless, it's probably worthwhile me saying that for me, I'm certainly forecasting that there's going to be a few difficult months, perhaps even a few difficult years ahead. But also bear in mind, whilst we're actually heading into a bit of a bear market right now, markets are obviously cyclical, which means they change, and sometimes for the better and sometimes for the worst. The reality is, as a long-term investor, you kind of just have to take the rough with the smooth. If you can put yourself in a position to capitalize when things get tough, then you'll only go on to benefit more when market conditions take a turn for the better. But as of right now, we certainly appear to be in a bit of a market cycle where we're reappraising the value of the stock market. Potentially reversion back to the mean market value, which could certainly suggest that there's going to be a little bit more downside to come just yet. So there's certainly my 2 cents. Be sure to let me know yours down in the comment section below. And if you do want to see a little bit more of an in-depth breakdown of some of my growth stocks and my investment portfolio, then be sure to click on this video here to see the crazy change in value that's took place over the course of the past month. And with that being said, I'll see you over in the next one.